Welcome to the BF Anderson Technical Report for May 30th. Difficult market. This is not a healthy looking market right now. We would really advise caution, which would mean honor your stops. I would keep any new buying very light. We're going to watch things very closely here, but as you can see here as we start out, the NASDAQ has rolled over and broken below the 50-day moving average, and the 25-day moving average has turned down. So this is basically a negative, and we just want to see if the market can consolidate. Now, volume last couple of days have been a little bit above average, so we are seeing some sellers. The sellers are pretty much in control right now. Best just to sit on the sidelines, kind of keep your cash. Don't use up your cash. If you do have cash, though, I would be getting it into the portfolio in anticipation of an upturn in the market, but we're not seeing it yet. Now, the other factor would be the weekly NASDAQ, which is showing that the 35-week moving average has basically turned down. Also, we are seeing a rollover on a weekly basis. Now, last week volume was somewhat light, and we've still got 2 more days to go this week. But what I would encourage you to realize here is that we're seeing what we call a break in the trend to the downside. However, what we want to now see is what we would call a violation of the trend. Now, if we break below the 35-week moving average for 2 consecutive weeks, that would be considered a violation, and I would be very cautious at that point. Now, on the advanced decline line, now remember, this is a very important indicator because it measures the net advancers over decliners. And as you can see here, the advanced decline line, which was in a very powerful uptrend, flattened out and is now kind of rolling over. So what I wanted to do was to kind of take another shot at this. Let's spend a little bit of time with the advanced decline line. Now what I've got here is a line showing the advanced decline line going back several years. You can see how powerful the uptrend has been. We broke that uptrend back last year, starting in September. You can see where we made the high and the lower high, made the low, and then we made the lower low, and so forth. So that's what you're really looking for defensive reasons, is to see if the advanced decline does become a downtrend. Now, so far, as we are now, we've got a high, we've got a lower high, but we actually don't have a lower low, but we're watching it. So what I wanted to do is go back and show you the advanced decline line about how serious the downtrend can be. If we go back to the bear market of 2007, you can see where the advanced decline made the high, the lower high, then the lower, made the lower low, then the lower low, and then the lower high and the lower low. And you can see how bad that decline became. Now, if we go back and look at the bear market of 2000, you see the same kind of pattern here. You see the high, the lower high, and so forth, and you see the downtrend. So the advanced decline is important. Net advancers versus decliners. Now on the high-low index, we're not seeing very many new highs, and we're seeing really a very uncomfortable level of new lows. We had 190 new lows yesterday, which was the highest really in about a year. We're starting. You can see now that we've broken above 40 new lows a day. Again, this just telling you that the boat is leaking, that we need to be cautious here. Now, on a long-term basis, we continue to be positive. The 10-month versus the 20-month moving average continues to be in an uptrend. Now, the index has pulled back to the 10-month moving average. We need to see if that's going to hold. On the put-call ratio, this is probably the best news that we have. We're getting a lot of fear. This is extreme fear here. Now remember, we got down here into greed, and I was basically saying several weeks ago that when we get down into greed or extreme greed, usually that means we're setting up for a correction. So as a contrarian indicator, what this is basically saying is that if you've got money sitting on the sidelines that you're thinking about putting in the stock market at some future date, this would be a real good time to be allocating those funds over to your portfolio, because you don't want to run into the market when everybody else is. This is basically saying that there's a lot of fear out there and that the market's discounting it. Now, on the another long-term graph that we're using is the 200-week moving average. It just was interesting how this has continued. The index, meaning the S&P 500, has continued to maintain an uptrend above that 200-week moving average. Now, we are getting a pullback here, but nothing close to where we were last year, where we came almost down to the 200-week. So the market on a long-term basis really looks pretty healthy. Now, let's talk about the small caps. The small caps have pretty much been a leading indicator. Back last year, the small caps were the first ones to break down. Then we got that, the worst December in history last year. So we had a very strong correction in the small cap stocks. Now, the small cap stocks tend to, be the, riskier side of the market. Now, the reason they're risky is they don't have as much liquidity. In other words, they, due to their size, they don't have as many shares outstanding, so that if a large institution starts selling those shares, it could dramatically affect the price. So what we have been noticing here really since February, we've been stuck in a trading range between 1,600 and 1,500. And then as of yesterday, we broke below 1,500 to 1,489.95. And, it's just not looking as positive as it could. Now, if we can hold it here and then stabilize and get into an uptrend, that's another story. But right now, caution is the word. Now, Value Line Geometric, this is, again, a 1,700 stock index, equally weighted. So you really are getting a truer picture of what the average stock out there is doing. What's frustrating here is we broke out in 16, rallied nicely up above 580. Now we're right back down to where we were back in 2016. So, due to the correction last year, plus the correction we're currently having, we're really not making the average stock is really not making a lot of progress here. We need to see that getting an uptrend. Just like the small caps, we need an uptrend there. Now, I wanted to point out also what's going on with energy. We're getting another breakdown in oil prices. As you can see here, this is West Texas Intermediate crude. We were starting to make some progress to the upside, but it has really broken down. I would avoid oil. Oil is just not looking good right now. And if you follow stocks like Chevron or Exxon or so forth, you know what I'm talking about. Again, what's really the problem here, now we could all point our fingers at China and the trade wars and all that, but interest rates are dropping. The trend is down. Now, if you're looking to buy a house and need to get a mortgage, this is probably a pretty good time to do it. Now, remember, back in 2016, in the summer of 16, we got down as low under 1.4%. Now, this is the 10-year Treasury note. So basically, the interest rates are dropping, so that's kind of indicative of a slowing economy. I really do think this is the problem. This is the major problem. Now, let's get into the top five. This is Mercado Libre, which is the Amazon of Latin America. This is really a very interesting company. We bought the stock. We own this stock. We bought the stock based on a breakout on very heavy volume. The average volume for this company is about 600,000 shares a day. On this particular day, it traded over 2 million shares. Now, they announced earnings. We bought the stock on what we call a gap up buy signal. Now, what you're looking for is for the stock to continue to hold that gap. You don't want it to break down below, it briefly broke down below the gap, but nothing severe. And the stock has pretty much maintained an uptrend. This is Match.com. This is the dating service. Again, we got a gap up buy signal, very heavy volume. Earnings were outstanding. It's continuing also to hold that gap. You want to see that it stays above where the gap took place. So we're buying stocks based on good earnings reports that the market reacts favorably to. Now here's ServiceNow, which is a software company. This is an interesting formation. You've got a very long base here, a breakout on earnings, and then another very long base. This stock, to get going, really needs to get back above 280. Roku. Now this is an interesting story. We own this stock as well. Again, gap up, but look how pretty that pattern has continued after the gap up buy signal, which came on 55 million shares, and the stock normally trades 13 million a day. So you got what you call a major gap up buy signal on earnings. Now, I heard a report the other day that 5G, which is the new technology coming that we're all hearing about, if you keep up with the news and know about Huawei and what's going on with these Chinese technology companies, 5G is coming. It's going to be a magnificent technology. Now, one of the areas that I hear that will be disrupted the most will be media, cable. Because what's going to happen here with 5G is you're going to be able to receive a signal over the air that you just won't need a cable any longer. It'll be that powerful. So Roku makes these boxes, and they also have a platform where you can stream movies, TV shows, so forth. So media is going to be very disrupted by streaming, which will come as a result of 5G in a very powerful way. They're talking like you'll get a 4K picture on your TV. You may even have to upgrade your TV. But Roku is a pure play in this area. Now, we know that Amazon's in the business, Apple's in the business, Disney is getting into the business, but this is a pure play in streaming technology. Shopify is, again, we're talking e-commerce. Again, the stock broke out on a gap up on very good earnings and has maintained a very nice uptrend since the gap up. Now, I'm mentioning the top 5 here not as buys, but simply as stocks to watch, because we want to always stay in tune with what stocks are leading the market. So thank you very much, and if you have any questions, please give me a call.